Hi. This week, we're talking about understanding personal finance. This is our introduction, and it's a general discussion about um, general topics in personal finance. So, we'll talk about keys to financial success, effect of economy on your personal financial success. We'll talk about different economic indicators and just to give you an idea of some of the major economic indicators. We'll talk about employment issues and we'll talk about professionals for financial advice. Um, what are your main areas or keys to financial success as your textbook refers? Um, we actually, summarize everything under four main headings, and the first one is spending, the second one is savings, and then investing and optimization. So, spending, obviously, it is centralized around spending your means. You should not expect you're not expected to spend more than you make. So think of it like a balance sheet, which we're going to talk about it in the upcoming chapters. But like a corporation, like a government, individual people also have balance sheets. That we have our assets and we have our debt, and we hope to have more assets than our debt. Also, we will talk about income statement, just as corporations or um, governments, individuals also have, perhaps not formally, but we actually have income statements. And it basically means that you have some sort of an income, and then you have several, expenses. So the item here on spending refers to your expenses. So as a person, your expenses are more about living. You have to rent, you have to eat, you have to pay for school, transportation, food, healthcare, insurance, and all sorts of issues. And you also have several different avenues of income. So you could have, you could be working, you could have an income from your parents, you may have hit the lottery and you wouldn't have to work, but then you would have savings. So savings usually refer to some sort of lump sum that you have accrued over the years, or you are accruing in your life through your checking or savings account, which again, we're going to talk about it next week. But it refers to putting aside some money for future use. Now, the future use could be for emergencies, for saving for graduate school, saving to pay student loans, saving to buy a new car, saving to get married, to have kids, saving to buy a house, and so on and so forth. So, but the savings refer to basically set aside X amount of dollars periodically for future consumption. Now, individual people, we tend to save for retirement. Retirement age in the US is 65. Different countries have different ages. But the main idea is we work all our lives, and at the age of 65, if you're lucky, we get retired, and then we start dipping into our savings. So all our lives, we save for something. We save to buy a car, buy a house, send our kids to school, and then we retire, and then we dip into our savings. Now, investing is a means to save more or to have our savings grow, and if possible, grow faster. So you can invest your money in several different investment vehicles. So just to show you, and I have a link to this on our Blackboard website. I have a website, researchata.com. And if you look at the basic terminology, this is a little bit more advanced lecture notes about finance. And the basic terminology, we will actually talk about this on week 5, but I also included this link to our first week concepts. But if you look at this, you'll find the basic terminology worksheet, and it will show you, what's a stock, what's a bond, what's a preferred stock, what is a portfolio, what is a mutual fund, an ETF. And up until this point, we're all talking about investment vehicles, securities. So the idea behind investing is you want to save money and you want your money to earn money. And obviously, if you were to invest, you are taking some level of risk of losing some of the savings that you might have. So we will learn about this in later courses in finance with respect to risk and return. And the basic concepts of investing are risk and return. If you take no risk, then you will have minimum return. So for instance, if you were to invest your money into a savings account or into a certificate of deposit, which we're going to talk about this week. So let's take a look at an example, say Chase Bank. And let's take a look at if they have any investment vehicles for us. So let's look at if they have CDs or savings accounts. So it's a very simple savings account, and they actually charge you money to put your money into this savings account. So again, we'll talk about this a little bit more next week or so. Checking account gives you the ability to spend money out of this account. Savings gives you a little bit of an investment income. But because the savings accounts are generally protected by Federal Deposit Insurance Corporation, which is backed by the full faith of the US government, they have very little return, if any. So let's take a look at the CDs, these certificate of deposits. So a savings account, you can basically deposit money and withdraw money, and you have access to your money at any point in time. A CD, or a certificate of deposit, will basically work like a time deposit. You put your money for a month or 3 months or 6 months, and you can't touch your money. You basically let it go for that term. But you will earn some return. So let's see if we can find, this is my zip code, just see how much I can earn. Let's see the interest rate. Right, so if I were to invest my money into a CD, I would earn, say I had, I don't know, $10,000, I would earn 0.02%. Again, no risk and almost no return. If I were to invest, however, for 9 months, which means that I give them my money into a CD to Chase, and keep my money there for 9 months, and remember, you can't touch your money for that 9 months, I will earn 2% per annum. So that's actually not a bad return. But again, this is very low risk, in fact, no risk, and you earn 2%. Now, if you're talking about higher risk, so for instance, if you're talking about investing in bonds or stocks, or preferred stocks or ETFs, then depending on the level of risk you're taking, you will have a little bit more of a return. So our financial success is all about optimizing our risk and return and what we are earning and what we are spending. Now, keep in mind that we all work for retirement, but there's no guarantee that we'll live to see retirement. So I find that in my life, it's all about optimizing my spending and my savings. It is nice to save and to have that security for future, for retirement, but we also have to live, and hopefully, we have some to spend for the time being. So it's nice to have a nice house, nice car, nice, nice life. But if you have it too nice, then we will have very little for future. If we have it too, penny pinchers, then we may not worry about that. I mean, we may have more savings for the future, but who knows if we're going to make it to the retirement. And so it's all about optimization, optimizing risk and return, optimizing spending and saving. Depending your age, obviously you will have, spending and saving optimization will be different. I am 45 years old, and to me right now, saving seems to be inevitable simply because I'm getting closer to retirement. And I like to have more and more available to me when I retire, because after a certain age, I won't be able to work and I won't be able to earn. And therefore, whatever I have saved is the only way that I can spend. And therefore, right now, I'm really worried about, I'm not worried, but I'm really concerned about having enough savings for retirement. Now, again, earlier, younger, you will have more tendencies to spend more, obviously, but then again, if you save more early on, you will have more for retirement. So it's about optimization. Now, obviously, the economy will have an effect, an impact on your personal financial success. It will have an impact on your spending, it will have an impact on your savings, and it will have an impact on investing. So, spending. Right now, US dollar is very, very strong, which means that our purchasing power, having earned or earning in US dollars, we now have a better purchasing power than we had 10 years ago. So just to give you an example, because the US dollar is so strong, any German import car, like a Mercedes or a BMW, is now approximately 30% cheaper than they were to us about 10 years ago. And not because the cars are cheaper, but it is because the US dollar is stronger. On the same token, if we were to go as a tourist to Europe, we would have 30% more purchasing power in Europe today compared to about a decade ago. So our economic conditions lead to a US dollar being too strong, and this affects our spending. Economic conditions also have an impact on our savings. Now, this is an issue because we will talk about inflation, but our purchasing power loses its power through time, or we are exposed to inflation. You talked about inflation in your previous econ classes. It simply means that diminishing purchasing power, meaning that your purchasing power diminishes through time. Now, our inflation is right now better than a lot of the countries outside of the US. Therefore, we are at an advantage, and that's one of the reasons why the US dollar is very strong nowadays. But overall, right now, our inflation is about 2%. So remember, when we looked at the CDs, we were actually earning about 2% in 9 months. Well, that's a little bit better than the inflation, which means that we're actually or we think that we're earning 2%, but we lose about 2% of our purchasing power every year. And therefore, we basically are not really earning much. So you see how the economic conditions just affected your savings. Now, also, if you think about investing in other countries, our economic conditions and their economic conditions will also impact your savings. So for instance, if you were to invest in bonds, buying a US bond right now, investing in a US bond right now, will make you, depending on how many years of a bond that you buy, 0.5% to about 2.5% to 3%. If you invest in another country's bond, like Argentina, for instance, you could make as much as 10% a year. So their economic conditions require them to pay 10% to borrow from you. Therefore, our economic conditions affect our savings as well as our investing. Now, our economic conditions today are so that a lot of the companies are doing well, and therefore their stock prices increase, and therefore we buy into these companies' stocks and we make money. And they pay us dividends, the stock prices go up, and we make money. If economic conditions were to reverse, like it did in 2007 and 2008, then the stock markets would go down, stock prices would go down, and we would end up losing money. So again, economic conditions would affect your personal financial success. Now, there are economic indicators that you could follow that would tell you pretty much the health of our economy. So think of it like, when you go to a doctor, they do a blood test and they give you, your white blood count and red blood count and then cholesterol and all that. So looking at those, you can tell if you have blood sugar, if you have certain diseases and so on and so forth. Very much like that. For our economy, there are indicators, and we look at indicators, and there are certain ranges that we want these indicators to be. And if they are within this range, then we expect our economy to be healthy. If they are too low, if they're too high, then we're concerned about the health of our economy. So CME Group is a good website to provide you with these economic indicators. Most financial websites will actually have these. If you go to CME Group, it's Chicago Mercantile Exchange. You go under education, and then if you look at the event calendar, and then we choose economic releases calendar right here. And let's choose July. We want the economic release calendar. And let's choose July. So beginning Monday, we have all of these economic indicators to be announced. So what happens is whoever is responsible to release that data, be it the treasuries or the central banks or Bureau of Statistics, they will announce it at periodic dates and times. And we already know these dates and times, they're pre-announced. So every country will have different dates and times, different frequencies of release of this data. So for instance, on Monday, let's see if we have any US data. Well, we have PMI, Manufacturing Index. We have construction spending. This is actually one of the important ones. If we spend too much money on construction, that means we're hopeful for future because we're constructing. So 6 months bill auction, this is a bond sale. And if based on this, we can actually look at how much people are paying or institutions are paying for these bonds, and we can calculate what the interest rates are. Tuesday, we have a 4-week US Treasury bond issue. We have a speech by Federal Reserve Bank President Loretta Mester. We have the Red Book, which is a Fed minutes, if you will. We have U.S. motor vehicle sales. Again, if the sales are good, this is good for auto manufacturers in the U.S. That usually means that economy is hopeful, forward-looking. If people are really pessimistic, they wouldn't buy a car. If people are hopeful, then they would buy a new car. And then we have another Fed president speech. Then we have other countries. On Wednesday, we have, so jobless claims, for instance, is one of the important ones. If too many people are out of a job, that means our economy is not doing all that well. If jobless claims are good, meaning that it's low, then that's actually good. So international trade, another very important indicator of our economy. How much import we're doing, how much export we're doing. Export is good because we're selling our products. Import is not so good because we're buying other countries' products. We want to have as much exports as possible and as little imports as possible to have a trade surplus. And if we have too much imports and too little exports, then we'll have a trade deficit. Now, if we have, think of it like this. When we have exports, we're selling products to other countries and we receive money. When we import, well, we're buying stuff and we're paying money. So if we have more money coming in through our exports than money that we're paying to buy the imports, then we're in a good shape. But if you're paying too much money and not receiving enough, then we will have a deficit. So based on this, we can actually tell how our trade situation is. So we have some very important indicators like gross domestic product. That's our production in the US, for every country actually, but for us, it's the production level of our country. If we produce more, then we sell more and we are better off. Our welfare is better. Our overall standard of living is better, and we produce more, and everything seems to be hopeful for future. Unemployment rate, obviously, if we have little unemployment, then that's good because everybody's got a job. And if we have jobs, then we spend. If we spend, then companies sell. If companies sell, they employ. So it's a cycle. Consumer confidence index. So if consumers are confident of future of our economy, consumers spend. If consumers spend, companies sell. If companies sell, they employ. And if they employ, well, they employ you. So it's nice to have consumers to have confidence in economy in the future, and therefore they spend. Inflation is loss of purchasing power in a way. So inflation is not good. However, deflation is even worse. So we want to have our monetary supply to increase as much as our economy increases or grows. We don't want to have too much money that's bigger than our economic growth, and we don't want to have too little money so to suppress our economic growth. So we want to have money just to suffice our economic growth. So, but management of our economy is not that easy. Think of it like this. If you're parking a car and you don't have those beep, beep, beep parking sensors, and you're trying to come very close to a wall and you can't look. So you want to come very, very slow and very, very careful until you actually feel the bump, but that has to be very, very small. So with our economy, it works the same. The people who are in charge of the economy, Fed chairman, they only can hear what's happening in the economy after they get the indicators. not while, after, which means they hear the bump, then they know they hit the wall. So any action that they take it very carefully, very slowly. So sometimes the economy will grow faster and there won't be enough money and they have to increase the money supply. And sometimes the economy grows too slow, but they increase the money supply too much and we end up having inflation. So economic indicators tell us the health of our economy, and the health of our economy affects our spending, our savings, and our investing. Now, this chapter also talks about employment issues, and your chapter has very detailed discussion about this. But mainly, what should you look at a job when you're considering a new job? So the first point would be to have a retirement plan. Most institutions will pay some sort of a retirement contribution, and you're allowed to set aside a retirement savings by the government pre-tax. Meaning you have to pay taxes on your income. So let's say you make $100. You have to pay taxes on that $100, income tax. Now, the government allows you to set aside some level of retirement savings from that $100. So say 10,000 or 10. So instead of paying income tax on that 100, you pay income tax on 90. So a lot of the times, institutions that you work for will set aside some sort of a matching retirement savings for you on top of your income, on top of your salary. So for instance, it's very common for institutions, for individuals to set aside about 5% of their salary as a retirement savings. So if you make 100, it's common that you set aside 5 as your retirement savings. Now, a lot of the times, again, the institutions will either match or pay you a little bit more. So for instance, they could say that we are going to match. So if you set aside 5%, they'll give you that 5%. This is on top of your salary. Most institutions will offer you healthcare, but the level of healthcare obviously will be different. So it could have deductibles. It may not cover your family. Excuse me. It may actually have significant differences from one institution to the other. And with the, this changes every day. So with the new healthcare laws that passed, but somehow every institution, hopefully that you'll end up working at larger level, bigger financial institutions, you'll have some sort of healthcare benefit as part of your employment package. Life insurance. Well, there are 2 types of life insurance, and one of them is simply referred to as a term life, which you pay something every month, and then if you die, somebody you left behind will receive X amount of dollars. But this is not accumulating, meaning whatever you pay is like a car liability insurance. You pay $100 a month and it's gone. So if, say, you take a term life, $100 a month, $1 million payment up until 65, and you outlive that. So you make 66, which means whatever you have paid up till then is gone. You bought insurance and it's gone. But if you happen to die before 65, then your beneficiary will receive that $1 million. Now, there's a second type of life insurance that's accumulating. That's almost like a savings account, retirement plan, if you will, that may have an attached term to it. but most life insurance that are accumulating will actually have a savings clause. So a lot of the employers will offer life insurance, but most of them will be term life, and quite rare they will have a savings life. And it is usually up to you to buy a savings life insurance. Depending on the state, depending on the type of life insurance you're taking, it could be pre-tax, but it is an issue that you have to read very carefully. There's disability insurance as part of Social Security in the US. Many countries offer disability insurance as part of their Social Security systems, and there is one in the US as well. But there are additional disability insurance, out-of-work compensations, and most employers will offer some sort of disability insurance as part of your employment package. Most of the time, these for retirement, healthcare, life insurance, and disability insurance will be on top of your salary as your fringe benefits, and most of these benefits will be, competitive depending on the job that you're getting. Better the job, better the benefits. Now, some jobs may offer higher salary, lower benefits. Some jobs could offer lower salary, better benefits. So you got to be careful what you are looking at. For instance, when I was in the job market for a professor job, I now find out that state schools offer perpetual health insurance if you work for them 20 years. I'm not sure if it still exists, but when I was first in the job market, I didn't know this. So if I were to be working 20 years for a state school, I would have actually gotten a perpetual healthcare insurance or health insurance after 20 years working for that institution. There are a lot of state agencies that provide such benefits. You work for 20 years and they give you health care for life. Now, this is a good reason to work at state agencies or state schools. Federal agencies also have very competitive fringe benefits. I know that most federal agencies will have that 20-year clause for healthcare, for retirement, for life insurance, and so on and so forth. So while their salaries may not be as competitive as the private sector, their fringe benefits might be significantly better. So there are issues for you to consider. Now, obviously, there are people who can give you advice. So, for instance, investment advice, certified financial advisors, financial planners. I'm sure that you have already know what a CPA is, or certified public accountant is, who helps you with your taxes. And these are professionals who actually have certificates, some sort of license to offer such services. And they have to go through a very rigorous training and testing and periodic upkeep and maintenance to maintain these titles. So having had these licenses, people are subject to regulation, and this regulation makes them vulnerable to legal claims. And therefore, they're very careful with respect to the advice that they give you. And if a person does not have these credentials and does not have these licenses, by regulation, they are not allowed to give you any financial advice. So for instance, I have a PhD and I do not have any other certificates or licenses. And therefore, while I can teach you what is what in finance, I cannot give you a financial advice. I cannot say buy this and buy that and so on and so forth. So, and if I do, I could get in trouble, real trouble, legally. Same thing for insurance, except with insurance, states regulate these significantly. So for instance, I was licensed to sell insurance in the state of Massachusetts back in the day, and you can only be, well, in that case, I was only allowed to sell insurance in that state, and that's it, no other state. And the test was repeated every other year, and there were a lot of stipulations that I had to work for a company and so on and so forth, so I had to let it go. But insurance is also highly regulated, and it also goes by license. And some states do not require licensing, but most do. So, check to make sure that when you are talking to somebody, if the state that you're living in requires insurance, that the person is licensed. With respect to retirement, it actually kind of goes within the investments, but different investment advisors will have different expertise. Some investment advisors are maximizing your wealth right now, and some investment advisors will have expertise in saving for retirement. So you need to ask the person what their expertise is. Also, retirement is a significant part of your taxes, meaning saving now for retirement into a different type of retirement schemes may have different tax implications, and that may actually save you money or help you invest better and earn better and have more money for retirement. Finally, insurance may have retirement implications. Like I told you before, life insurance can be term life or savings, accumulating life. And in certain cases, this accumulating life can be used for retirement planning. So depending on the type of insurance, life insurance product that you're considering, the person who's advising you might be able to help you with your retirement as well. So our chapter this week on understanding personal finance also has issues with relate to time value of money, compounding interest, future value, time value, present value, and so on and so forth. Those are pretty straightforward with respect to math calculations, and there's just not much math. And our quiz do not have any math. These will have more importance for us in later weeks, and you're going to have to deal with those issues in your Finance 300 course. So for the time being, our understanding personal finance is about it. So let me know if you have any questions, and welcome to the course. And hopefully we're going to have a nice semester together. So again, please do let me know if you have any questions. Thank you.